A few weeks ago, the single biggest question on Wall Street was whether SpaceX was priced for absolute perfection. We're talking about a company stepping into the public market with a valuation in the trillions, making massive bets on Starlink, AI, and deep space logistics all playing out flawlessly. Well, we are finally getting our first real answer, and honestly, it's a bit of a paradox. SpaceX stock has actually fallen below the price it opened at on its very first day of trading. This was the most anticipated IPO in history, backed by nearly every major Wall Street bank slapping a buy rating on it, and yet, it's already underwater from where the public first jumped in. So is that expectation gap finally catching up to the price?
Naturally, this brings us to the literal trillion-dollar question. Is this massive bubble popping? The tension right now between those flawless, futuristic expectations and the sobering reality of the public market is just fascinating to watch. See, when buyers jumped into SpaceX, they weren't exactly paying for what the company earns today. They were paying for what it might become in the distant future. I like to call this the tyranny of perfect expectations. When you price an absolutely flawless execution across all these unproven, wildly ambitious businesses, you leave literally zero room for the company to just disappoint, let alone actually fail.
Section 1. IPO price versus open. Okay, to understand what's actually happening with the stock right now, we need to get our timeline straight. A lot of recent headlines are dangerously blurring two completely different numbers together. And if we want to understand the real market mechanics here, we have to separate the facts from the sensationalism. On June 12th, SpaceX executed the largest IPO in history. They priced their shares at $135, raising an astonishing $75 billion, debuting at a valuation of nearly $1.8 trillion. But when the market actually opened for its first trade, the price instantly gapped up to $150 a share. The hype was so intense that by day 3, in mid-June, the stock had spiked to an all-time high of around $225, making it briefly one of the most valuable companies on Earth. Fast forward to today, though, and the stock has pulled way back, settling into a range around $148 to $153.
So here's the really crucial part. You have to understand the difference between the institutional reality and the retail reality. Technically, SpaceX is not below its IPO price. If you're an institution lucky enough to get in at that initial $135 offering, you're still sitting comfortably in the green. But for the massive wave of retail investors who got caught up in the FOMO and bought during that initial $150 opening hype, or even worse, bought near the $225 peak, they're experiencing very real, very visible losses right now. The pain might be isolated, but for the public, it stings for sure.
Moving on to Section 2, 3 reasons for the dip.
So why exactly is one of the most hyped stocks in history losing its footing so fast? Well, it turns out this isn't just some random market fluctuation. There are 3 concrete, real-world factors converging right now to drive this pullback: competition, debt, and looming lockup expirations. None of this is about blind panic, okay? It has everything to do with shifting supply, demand, and the cold, hard realities of corporate finance. Let's quickly break these down.
First up, the competition. Jeff Bezos' rocket company, Blue Origin, just announced they're raising a massive $10 billion at a $130 billion valuation. What makes this a huge deal is that it's the first time Blue Origin has ever raised outside money. That is a loud, direct signal to the market that a highly serious, incredibly well-funded competitor is gearing up to fight for the exact same space that SpaceX has basically had all to itself up until now.
Second, there's the debt factor. SpaceX recently confirmed its first-ever bond issuance. Now look, SpaceX is projected to generate a staggering $18.7 billion in revenue in 2025, which absolutely proves the underlying business is a powerhouse. But taking on debt via bond issuance, that always makes public investors a little jittery. It introduces new interest costs and brings up very real fears of future dilution. It's like the market is suddenly waking up to the fact that even a trillion-dollar behemoth needs expensive capital to keep its engines running.
And our third, and honestly maybe the most critical factor, is lockup expirations. When a company goes public, early investors and employees aren't allowed to just dump their shares right away. They're bound by a lockup agreement. Right now, less than 5% of SpaceX's shares are actually floating out there for public trading. The rest, locked up tight. But those locks are going to start expiring soon. Analysts are estimating that insiders could eventually sell off a huge percentage of their shares. And when that happens, it's going to flood the public market with massive new supply, which puts even more downward pressure on the stock price.
Section 3. Wall Street is still bullish.
All right, here is where we hit the most fascinating disconnect in this entire story. Despite the heating up competition, the new debt, and that looming tidal wave of new shares, Wall Street analysts have absolutely not turned their backs on SpaceX. In fact, they're aggressively maintaining buy ratings, pounding the table on this stock while the retail market is the one hitting the panic button. Just look at this incredible gap. The stock is trading around $148 today, but in just the last few days, major banks came out with massive upside targets. UBS is targeting 210, JP Morgan says 225, Macquarie came in at 250, and Morgan Stanley's Adam Jonas, he set a staggering price target of $300 a share. Nearly every major bank covering this stock is wildly bullish, even as the actual trading price drops.
And that extreme split right there is what creates the whipsaw effect. The current price action is screaming at you that the stock is cooling off, but the institutional sentiment is whispering that it still has massive upside. This exact scenario is incredibly dangerous for everyday investors. It makes people do highly emotional, terribly timed trades, like buying into the intense hype at the absolute top, and then panic selling the second they see a real structural pullback.
Section 4. The Big IPO Pattern.
So how do we process this kind of extreme volatility? Well, the best cure for market emotion is usually just looking at history. Let's normalize what we're seeing by looking at the textbook pattern for these massive, incredibly hyped public offerings. If you look at the 15 largest U.S. IPOs in history, the average stock has fallen about 30% from its IPO price at some point during its very first year. And this happens even to companies that go on to be phenomenally successful in the long run. Big, highly anticipated IPOs almost always run up extremely fast, purely on emotion and speculation. But they inevitably cool off hard once that initial excitement fades and the market forces real financial metrics to start mattering more than just a cool, futuristic story.
So the big takeaway here, this dip isn't concrete proof that the SpaceX bubble has permanently popped, nor is that proof that there was never a bubble to begin with. What we are witnessing right now is simply the market actively testing that astronomical expectation gap in real time. The initial fantasy phase is over. Now the market is demanding to see if the reality can actually support a multi-trillion-dollar price tag.
Look, understanding exactly why a stock moves, whether it's well-funded competitors like Blue Origin, new debt structures, or expiring lockup agreements, that is literally the only way to build a real, durable investment strategy rather than just reacting with raw emotion. Panic buying because a stock is down is just as dangerous as panic selling. So I want to leave you with a direct question as you look at all these moving pieces. Given the undeniable potential of this company versus the very real structural pressures pushing its price down right now, are you buying this dip, holding your ground, or staying far, far away?